discussions, and of course the market very much in focus as well. I'm Prashant. With me, my colleague Surabhi and Nigel. Guys, hi, morning.
Hi, morning folks. I was just thinking, Prashant, and you'll remember this. I think in our careers, this becomes the third biggest seminal moment, which is sort of global in nature. The first was the global financial crisis that we reported on. The second, obviously, was COVID, and now this, Donald Trump trying to reorient the world, shift its axis, get manufacturing back to the US. Whether it'll work or not, we'll find out.
I feel a few years younger now. Thanks for that, Surabhi. But, I think the hope was that the bite is not going to be as bad as the bark. It didn't play out that way. It appears President Trump means business, at least of what we heard as of now.
I mean, it's just, I know that picture of him holding that placard, right? I mean, it's just incredible. Scenes that we've not seen before. I mean, the president of the US standing there, we're going to charge this, we're going to charge this. It's
and that was his pitch as well, right? That in a couple of years from now, you all will figure that I was right. And this is about making America great again, and the golden age and wealthy again and all of that. So.
Well, let's drill it down in terms of how we are stacked up, right? We'll look at the market first, and I'll give you a quick sense. It's about a 1% cut on the GIFT Nifty as we begin this morning. US futures are down sharply. Asia is down as well. And the graphics will come up on your screen. So about a 250 odd point cut on the GIFT Nifty is what we are showing at this stage. I mean, the point is yesterday the market went up 160 points. So that's got to reverse. That's got to go. And then there'll be some more pressure. So 250 to start with, maybe higher as we go along, because the rest of the world is, of course, much under pressure by a lot more. Now, more sort of global market indicators in a bit from now, but let me just get straight to the sort of tariff news. So Trump's reciprocal tariffs, neither nice nor kind. And I'm just taking off from what he himself said. Well, they'll be nice and kind, but neither of those two, much harsher than expected. And as I began by saying, and we were kind of sort of phrasing this in a clear way, right? Will this be a risk shock for markets or a clearing event? And I think it's pretty clear what it is. It's a risk shock. And those who were expecting this to be a risk shock, what has actually been delivered is actually worse than that. Those expectations as well. I mean, Goldman Sachs, for example, were saying that they expect tariffs. Now they revised it higher. But even after that revision, they expected tariffs to rise by about 15% or so. It's risen more than that. Now, just a quick run through. China has been assigned a tariff of a total of 54%, EU 20%, India 26%. And of course, there's a whole list of countries, and we'll get to that in a bit from now. The thing is, tariffs are being levied based on an estimate. At least that's what they're claiming. This is an estimate of both the tariff that other countries are charging the US and their estimate of non-tariff barriers. Things like VAT. Is the currency of that country being artificially suppressed so as to help exports? So, I mean, that is essentially what is going into their calculation of what the reciprocal tariffs are going to be. And of course, they're taking half of it. And that's what they're saying. It's a discounted rate in that sense. Now, the thing is, the hope is really that Trump is and this is globally the case. And they've also said it. The White House, I think, has issued a statement that these tariffs will remain in force as long as President Trump sees them fit. And based on negotiations, etc., they can be brought lower. So that's the hope. The problem is, since these reciprocal tariffs are based on tariff and their estimate of non-tariff barriers, say, for example, a country like India, if we lower our tariff rate by, say, X%, how much will that translate in helping the US tariff to be brought lower? Because it's not just the tariff rate, it is these non-tariff barriers which go into that calculation as well. And I think, that is something that we need to watch out for. We'll discuss with guests as we go along. Just a quick bit, effective US tariffs now rise to close to 25%. When Trump took office, it was about 2.5%. JP Morgan says this basically translates, these hikes basically translate into a tax hike for the US of about $660 billion, which is about 2.2% of GDP. I mean, that number is enough to wipe out and throw and push US into a recession by itself. And of course, JP Morgan has also got something to do about the world. They say that large tariff shock threatens US in a global recession as well. Now, just a quick bit on India. Indian exports to US, and these are just rough and dirty calculations. I just looked at the India exports to US. They were $91 billion. A 26% tariff translates to about $24 billion as a percentage of GDP. Our GDP is about 0.6% of GDP. But of course, I mean, it will not be that. It will be most likely lower because it's not obviously, I mean, there is exemptions right now. And of course, all of it is not going to be borne by Indian manufacturers. Pharma specifically finds a mention. A lot of commentary around how pharma could see a relief rally. The sector has been exempted, but I must say for now, because the executive order clearly states that some sectors on which tariffs have already been imposed and sectors on which tariffs are yet to come under the national security section. I mean, so they've been talking about onshoring and getting manufacturing to the US. So these sector level tariffs may come later. So be mindful of that. Just to tie in the levels, we start sharply lower for the Nifty. We get to the first big support zone, which is 22. I mean, it comes in at 22,867, which is the 20-day moving average, and then 22,692, which is the 61.8% retracement of the bounce that we've seen from the 3rd of March low. And similarly for the Nifty Bank, the 20-day is 49,534, and then the 61.8% retracement is 49,368. So a red day, and I'm assuming not very many places to hide. Maybe pharma is one for now to begin with, but one needs to be mindful. The tone, the tenor, what they want to do is very aggressive. So will they really, after talking about pharma for a long time, will it be completely exempt for all time to come, or will we have to deal with it later? That's the question. Surabhi.
Absolutely. Well, actually, Prashant, before I get to how some of the Asian markets are reacting, and there's a statement out of China already. They're saying we will take resolute countermeasures, against the imposition of these very stiff tariffs from the US. So more on this in just a bit. But let's actually listen in to some of the excerpts that came in from last night's address. Donald Trump announcing this new Liberation Day.
My fellow Americans, this is Liberation Day. Waiting for a long time. April 2nd, 2025 will forever be remembered as the day American industry was reborn, the day America's destiny was reclaimed, and the day that we began to make America wealthy again. We're going to make it wealthy, good and wealthy. For these reasons, starting tomorrow, the United States will implement reciprocal tariffs on other nations. It's been a long time since we even thought of that. We used to think about it a lot. We didn't think about it for many decades, and you see what's happened. For nations that treat us badly, we will calculate the combined rate of all their tariffs, non-monetary barriers, and other forms of cheating. And because we are being very kind, we're kind people, very kind. But we will charge them approximately half of what they are and have been charging us. So the tariffs will be not a full reciprocal. I could have done that, yes, but it would have been tough for a lot of countries who didn't want to do that. Not a full reciprocal. I could have done that, yes, but it would have been tough for a lot of countries who didn't want to do that. So if you look at that, China, first row, China, 67%. That's tariffs charged to the USA, including currency manipulation and trade barriers. And so we're going to be charging a discounted reciprocal tariff of 34%. I think, in other words, they charge us, we charge them less. So how can anybody be upset? They will be, because we never charge anybody anything. But now we're going to charge. You think of the European Union, very friendly. They rip us off. It's so sad to see. It's so pathetic. 39%, we're going to charge them 20%. So we're charging them essentially half.
Hey, what do you say? It was political theater, but it's economic reality as well, not just theater as well. Now let's see how this reality is playing out across Asia. Markets are down. But I must say that markets have slightly, just that ever so slightly recovered. The cuts are between 1% to as much as 3% across the Nikkei, for instance. That's the market that's falling the most. Nikkei is still down about 3%. The South Korean market is down about 1% right now. And Hong Kong is also lower by about 1.5%. Mainland Chinese equities relatively better off. Very, very flat on the Shanghai Composite, must say that. And China, like I said, has just been issuing the statement saying that we will, we propose, an immediate resolution and proposing that the US immediately cancels reciprocal tariff. Otherwise, China will take, and I quote, resolute countermeasures. So let's see. The rhetoric and the back channel parlays, all of that has begun. Very quickly, let's pull up the table for Asia. Where do those tariffs stand? China is at 54%, the highest. We come in at 26%. South Korea is at 25%. Look at the others. Vietnam, one of the major manufacturing hubs in the region, 46%. Thailand, 36%. Bangladesh, massive for textiles and one of our biggest competitors in textile and apparel exports, 37%. Likewise for Sri Lanka, major player in apparel exports, 44%. And there's Indonesia, Malaysia, Australia the least at 10%. By the way, the Australian Prime Minister also came out with the comments saying Trump's decision is not the act of a friend. South Korea has responded by taking emergency measures. Their Commerce Ministry has gotten into a huddle and they're saying we are going to start negotiations very, very soon to pressurize the US to lower tariffs. A lot of the automaker shares, by the way, across the region are down. Nothing new for them, but it's just that 25% auto tariff that gets implemented from today. So your Kia, Hyundai, Nissan, Honda, Mitsubishi, all these shares are down between 1% and 4.5%. Now, the silver lining for India, want to be a little hopeful as well this morning, is that A, we're not alone in this. B, if you heard a lot of the companies, talk to us through companies were saying that everybody will get hit. So relatively speaking, if our competitors, exporting competitors get hit more, for instance, China, for instance, the markets in the textile trade like Bangladesh, Vietnam, then can some of the Indian manufacturers hope to benefit? Let's see. That's the silver lining. And last but definitely not the least, the fact that pharma, at least for now, has been left exempt. So maybe it's a small breather, but one that we want to hold on to. Very quickly, beyond the tariff headline, just because there's a lot of domestic news flow as well, I just want to leave this on the radar. Dabur, the fund flow picture, fund flows are on your screen. 1,500 crores of selling yesterday, which was lower than the last 2 days. But let's see how these numbers evolve. Dabur is a bigger story domestically. Dabur's fourth quarter update is again very, very bleak, very similar to the third quarter update. There's been no pickup in the fourth quarter. Dabur, in fact, is saying that their consolidated revenue will be flat and the India FMCG business will decline in mid-single digits. And the margin is going to be falling by about 150 to 175 basis points. That's a stinging statement coming in from Dabur. They're saying there's no pickup in demand and the general trade continues to be under pressure. So aside of all the tariff talk, this is one stock, domestic facing, but yet we need to, watch carefully.
Well, I recall when Trump won the elections, right? What was the talk? He's going to be good for equity markets. He's going to be good for the cryptocurrency. You want to revisit that? Liberation Day or Liquidation Day? Just take a look at the cryptocurrency market. It's lost $200 billion in the last 3 to around 4 hours. And even the stock futures in the United States, well, they are sharply lower. So this Liberation Day has turned into Liquidation Day, particularly for the US markets out there. On India, the silver lining is that India, well, the tariffs are relatively low if you compare it with some of those peers like Surabhi mentioned, Bangladesh, Pakistan, as well as China. Morgan Stanley note, well, they have highlighted maybe there is some scope for negotiation as well. And that's the hope out there. One positive, though, is that part of the uncertainty is out of the way. Because the markets don't like uncertainty. At least you've heard what the man has to say. And from here on, the hope is maybe, in fact, there will be better times to come. Maybe there'll be some kind of renegotiation. Maybe it doesn't go the whole haul. That is the hope out there. What about the FIs? How are they positioned? They're net short. Close to around 68% of their positions are on the short side. In the last few trading sessions, they added some shorts. So overnight, well, it was pretty much more or less flattish. And the clients, as well as the FIs, they are on opposite ends of the spectrum. Mildly so. We have been making this point at the start of the series as well, that the open interest is relatively low if you compare it with the previous series. The important levels you need to track. As the GIFT Nifty is suggesting, we pull back by around 300 points or thereabouts. That would mean that we're going to be starting closer to around the 20 DMA. By the end of today, I want to see that 20 DMA getting defended. If that 20 DMA is defended, it still gives you hope that we could see a bit of a pullback from here on. Though, keep in mind, global equities are likely to be in a bit of a flux. The range that you're looking at in terms of support, the 22,800 odd level, you don't want that level to break. The Nifty Bank, extremely important player for today because, you're talking about tariffs. You'll want someone to come in there and bat for the bulls. It could possibly be the Nifty Bank. You have the April 1st low, that's a couple of sessions ago, 50,750, that level shouldn't break. The 200 EMA as well is the level that you'll want to conquer on a closing basis. Keep in mind, today the volatility will only pick up because for the Nifty, it plays out the weekly expiry. The sector of the day is clearly going to be the Pharma Index. In fact, if you look at the yesterday's intraday chart on the Pharma Index itself, it ended at the high point of the day. But today, you very well have a big gap up opening on the pharma stocks because some of them have underperformed, and stocks like Oro, Dr. Reddy's, as well as Zydus, all of them, well, they have a fair bit of exposure to the US market. So by the end of today, you'll want India, to recover from the first hour's lows. And let's see how that plays out. The FI sell number is going to be most crucial by the end of today.
Absolutely, and I think it's a long day, and we're just getting started in that sense. Points taken, Nigel. Well, it's Tariff Thursday, and we have a power-packed lineup on CNBC TV18 all day today to analyze tariff implications for industries, sectors. So top voices across the globe. Ed Yardeni of Yardeni Research, James Knightley of ING will be joining us very soon. We'll have top market voices and economists like Sandeep Bhatia of Macquarie Capital. Neelkant Mishra will be joining us from Axis Bank. Kulin Lalbhai of Arvind Textiles will be in focus. We'll talk about that as well a little later. Sameer Narang of ICICI Bank, the economist there. Pranjul Bhandari of HSBC. We'll have Nilesh Shah of Kotak Mahindra Asset Management Company who will be with us as well to discuss the implications from this. And of course, the macros are important. Ashok Gulati and Ajay Srivastava will be speaking with us on as far as the implications for agri, industrial products and some of the other specific sectors as well. That is just a teaser of some of those who are going to be joining us.
Okay, well, it's a long list. Some of the top seasoned bureaucrats also will be with us today. Najib Shah, S.C. Garg, Gemini Bhagwati and Amitabh Kant, all of them will be joining in to analyze the impact of those US tariffs on India. We will also be joined by the top industry experts and economists like Anurag Sehgal, Gneshwar Sen, Neha Anna Thomas and Sakshi Gupta to discuss the implications of Trump's 26% tariff on India.
Okay, we have our first set of guests with us. Ed Yardeni, President at Yardeni Research is with us. James Knightley, Chief International Economist at ING is with us as well. Gentlemen, thank you for waiting longer than usual. We were getting done with everything which has happened. Ed, a simple question. Obviously, these are much harsher than the worst estimates that I saw out there in the street. Hope is they will be negotiated lower, but your first thoughts?
Well, back a few days ago on Monday, I wrote a piece characterizing this as the reign of tariffs, Trump's reign of tariffs. And I actually lowered my outlook for where the S&P 500 might end up the year, lowered it from 6,400 to 6,000. And today that may look a little too optimistic given the reaction of the markets. But my first thoughts are that this is not a good policy. This is a very bad policy. And the only good thing is that maybe there'll be negotiations that will reciprocally lower tariffs. We don't want these tariffs to remain intact. So lowering tariffs may be the outcome of negotiations. The problem is that there's still a 10% tariff, which is apparently a tariff that won't go away. And I think the Trump administration intends to raise $300 to $600 billion at an annual rate with this tariff. And that may still be too high for some countries.
James, your first thoughts, and just one specific thing. These tariffs, these reciprocal tariffs include non-tariff barriers as well. So, for example, in the case of India, the table will come up. They're saying the tariffs charged to US is 52%. Now, that is their estimate of, VAT, forex, currency, and other things, right? So, in this, what Ed is saying, that maybe tariffs go down for everyone. But the point is, there is a limit to how much you can cut tariffs and then hope for Trump to lower his tariffs as well, because it is not entirely just tariffs. It is their estimate of all these non-tariff barriers as well. James, go on.
I would cast some doubt on that, because there's a growing story here in the United States that actually, where did these numbers come from? Because if you look at some of those numbers, like 97% charged by Cambodia, it's raised a few eyebrows as to where these numbers are really coming from. But someone has come up with the solution. You can run through this, and basically what they've done is they've taken the trade deficit. They've come up with this idea that it is this tariff rates plus non-tariff barriers. But what we've got is it's basically looking at the ratio of exports to the US divided by the trade balance. And if you run through that and look at all the countries, that is exactly what they've done. These aren't a scientific calculation of all the trade tariffs and all the barriers at all. It's seemingly somewhat of a fabricated number. And then to say, well, we're going to charge every country 50% of this. Again, it does suggest that this is, you know, you would hope that political leaders around the world are going to pick up on this and think, hang on, this is not what we charge you whatsoever. So I think that there could be some reasonable scope for some renegotiations here, as a lot of countries make the point that these numbers do not match up with reality, basically. So that gives me some hope that we will get a recalibration. But you know, this is Donald Trump, and we've got to be prepared for.
No, we saw that.
volatility.
We've seen that. We've seen that. I think Ed must have also seen it, right? That ratio.
Yeah.
So as you said, I mean, it looks like a fabricated number. So is that? I mean, then if they've just pulled this out of thin air, how should one read this? That they just want a high number somehow. So you get to that high number, but then they're willing to backtrack and lower it far lower, or they just want to go ahead. Ed.
Well, look, I think the most important story here is that we're still talking about 25% permanent tariffs on steel, aluminum, and autos. And I think this has the potential to bring inflation back in a serious way in coming months. And if that's the case, I think that has the potential to really depress the consumer. And this time around, the Fed is not going to be able to come to the rescue here because it can't possibly lower interest rates when inflation is significantly above its 2% target. I think that inflation, which has been running around 2 to 3%, is about to run at 3 to 4% because of these ridiculous tariffs. And the notion that foreigners pay tariffs is absurd. The reality is Americans are going to pay the tariff, and it'll be mostly American consumers. And they're already very angry about the inflation they've experienced during the Biden years. And they were promised by this administration, that they would lower prices. And it's going to go quite the opposite way. I think the Republicans are running the risk of losing their majority in both houses of Congress next year. I think this is just a disastrous policy.
So we're seeing some of that, right? By the way, the U.S. 10-year yield, it's cooled off. It's now almost at the 4% mark as we're seeing that flight to safety play out. Gentlemen, so two-part question. Let's first talk about the impact. For now, whether these are scientific numbers or not, they are the numbers. He's just declared them, so we have to deal with them, right? So, Mr. Yardeni, you said you've lowered your estimates for the S&P 500. What about the U.S. economy itself? Do you believe? Because earlier you were very, very confident about the health of the economy. Do you believe that a recession could be a reality now?
Well, the extraordinary thing is how well the economy performed over the past 3 years in the face of a significant tightening of monetary policy. I was one of the few economists who said that we would not be a recession. And so I'm kind of still hoping that the economy will prove its resilience, but this is a major, major stress test, and I've lowered my expectations for this year. I haven't lowered my expectations for the rest of the decade. I still think there's a chance that we'll have what I've called the roaring 2020s, but that doesn't look very realistic right here. So I've lowered my numbers to about 1.5% real GDP growth this year, and I was thinking it could do like what it did last year, which is 2.5% to 3%. And we could have a very strange year where growth is maybe 1% or less in the first quarter. Then it could be up 3% in the second quarter because people are buying cars left and right before the tariffs drive up car prices. And then in the second half of the year, we could have a real slump led by weaker consumer spending.
1.5% best case U.S. growth for 2025. Got that. James, similar question to try and map the growth implications for Asian exporters, right? Because Trump is trying to shift the world's axis. He's saying, the U.S. needs to manufacture. So countries like South Korea, China for that matter, manufacturing was all about Asia. It was the Asian tiger, so to speak, right? How much immediately in this year would you expect the growth impact to be for Asia?
Well, we're already seeing a reaction from the US consumer. We stand a very real possibility that we have negative consumer spending growth in this first quarter, as Ed alluded to. And I think in this environment where we've got households that are very worried about their spending power, and that's going to be intensified by the effects of the tariffs. We've got households worried about austerity. What does that mean for jobs? What does that mean for entitlements? And then if you overlay that with the third threat, which is sliding equity markets and perhaps possibly declining wealth levels in America, it's a pretty poor recipe for growth, certainly this year. For the US economy. So that does translate, we would fear, into, we've had this wave of imports to try and preempt some of the tariffs, that we do see much weaker exports into the US later on this year. I think certainly, it's going to be years away before we see meaningful reshoring to the United States. So there will obviously still be plenty of opportunities. But the big fear is not necessarily the tariffs itself for these Asian exporters. It's much more going to be, what is the US consumer doing, and what is the knock-on for the rest of the world in terms of the global growth story?
Mm-hmm. Well, take that point, James, and it'll be interesting to see if they're going to be getting additional revenue. That's the US administration. What do? Do they go ahead and they implement some tax cuts so to keep the economy afloat? But James, earlier when we had spoken, you were factoring in a couple of rate cuts from the Fed. That goes out of the window now for 2025 itself?
No, I don't think so. Again, Ed's probably got a more upbeat medium to longer term view on the US consumer than I perhaps do, so therefore perhaps feels that inflation is more sustainable. But I'm more of the mindset, well, these tariffs are probably going to be a one-off. I would hope they're going to be a one-off, and that we could potentially see them either rolled back in coming weeks or potentially rolled back in subsequent months. So there certainly is going to be a near-term spike up in inflation, but in 12 to 18 months' time, are we going to be in that sort of still lingering at 3 to 4%? I'm doubtful, and I think the Fed, being somewhat forward-looking, okay, they have already implemented 100 basis points of rate cuts, but I think they'll be looking at the more pessimistic outlook for US growth that analysts are having, and they presumably themselves are having as well, and are looking medium to longer term. What is inflation going to be in, say, 18 months' time down to perhaps 2 years' time? And therefore, there's still, I think, scope for 2 rate cuts that we have. We've got I think near term, the Fed are going to be hesitant. We've got a September rate cut and a December rate cut and a March 2026 rate cut. I'm still sticking to that for now. And it is more the growth story looking at more negative in an environment where inflation is higher.
All right, so you're sticking to that Fed rate cut forecast that you gave us earlier. Before we wind up, Ed, 6,500 on the S&P 500, lower to around 6,000. What should it look like, give and take whatever we have, what we've heard from President Trump? He was supposed to be good for the US market, but it seems, as of now, it's likely to get into a bit of a tizzy. What should be the number we're looking at on the S&P 500?
Well, I've lowered it quite a bit. I started out the year optimistic, thinking that Trump would get it right. Instead, he seems to be getting it very wrong. And I had 7,000 by the end of the year with strong earnings and valuation multiples staying up. But like everybody else, I've lost my confidence in Trump's ability to do this right. And as a result, I a couple of weeks ago lowered it to 6,400 on the S&P. Now I'm down to 6,100, 6,000, 6,100. I think that's still a realistic, achievable goal, but I think it's going to require that either we negotiate a lot of tariff reductions and or the president declares victory one way or the other and backs off of this potentially disastrous policy.
No, got that. James, one last question. I'm still sort of looking at the basics, right? You said you started with that number, that starting point is kind of, you said fabricated. Have you confirmed that, because it's all over, and I think it's a theory in the US as well. Is that confirmed, and how does that work? So, for example, India, our exports to US are about $91 billion. India runs a surplus. So US runs a deficit of about $40 billion. So, what is this formula, this fabricated formula? In that sense.
So it's the 40 divided by the 90 to give you the sort of rough 50%, and therefore halve that, and you get to about the 26% tariff that is being applied to India.
And it looks like this is what they've done, or it's just sort of coincidental that it's.
You can get the same number. So for the EU, the ratio works out at about 40%, 39%, I think it is. And so what they've done is basically halved it and given you a 20% tariff. For countries where they are running a trade surplus, well, where the US runs a trade surplus, so for example, the UK runs a trade surplus, but it therefore gets the minimum 10% tariff.
Got that. So I asked Ed this, if this is, they've pulled this out of thin air, so like they wanted to be very maximalist in their opening move. So say 52 and say we're only imposing 26. So does that mean anything from a very near-term market perspective, James?
Well, I think it means, it suggests that political leaders around the world have got some scope for negotiation, saying, well, that's not actually the number, and coming up and proving it, and therefore they've got perhaps a little bit of leeway. But we come back to the point that Donald Trump actually really needs the cash if he's going to give, he needs the fiscal headroom to be in order to enact these extended and expanded tax cuts that he's promised us all. So he needs the money as well. So that's got to be coming into the thinking too. All right.
Gentlemen, thank you very much. I reckon it's been a long day for both of you, and I think it continues to be a longer day for us here. Thank you very much for staying up. Thank you for joining us, Ed and James. Great to speak with both of you here on CNBC-TV18. Well, we'll take a quick commercial break here, but that kind of really sets you up in terms of just thinking about these tariffs at a broader sort of macro level. We'll talk about stocks, which our team is watching out for, because there are implications for pharma and other spaces. That's coming up.
And they all understand. We're going to have to go through a little tough love, maybe, but they all understand. They're ripping us off, and they understood it. April 2nd, 2025 will forever be remembered as the day American industry was reborn, the day America's destiny was reclaimed. Very, very tough, very, very tough. The Prime Minister just left, and he's a great friend of mine, but I said, you're a friend?
Welcome back. You are with us on Bazaar Morning Call, and we're coming to you from the CNBC-TV18 Motilal Oswal studios. It's a roller coaster morning this morning. It's the Thursday tariff effect that's really playing out. Very quickly, let's pull up the Asian markets again. Still down between 1% and 3%. That's the reality of it. Let's also pull up the GIFT Nifty and the implied open to get a sense of where we could start, because Asia is down, like I said, 1% to 3%. Some of the markets have recovered a bit. The cuts are not as deep as, originally the Nikkei had opened down 4%. Now it's down about 2.75%. That is our implied open. 250 points gap down is where we'll probably begin the day. Beyond the tariff headlines, of course, a lot of individual stocks to track as well. Some because of the tariff news, some because of other news flow. So let's straight away get to our list of top stocks to watch. Guys, morning to all of you. Let me start first with Sudarshan, who's watching out for a bunch of auto stocks. I think some because of the sales news, and others, I'm sure, because of the tariff news as well. Sudarshan?
So for today, majorly I have two stocks. First one is Hero MotoCorp. I'm going with red on the stock despite companies reporting March sales which are higher than estimates and are up 12% if you compare against the same month last year. But the reason the sales are higher because of impact has come in due to emission standard norm which came into effect on April 1, and due to that last week of March saw pre-buying. That's the reason these numbers are looking elevated. If you look at the Q4 numbers, Hero Moto has underperformed peers. Q4 growth, Hero Moto has reported decline, while all the other companies like Bajaj Auto, Eicher Motors and TVS Motor have seen a growth. So that's the main reason I'm going with red for Hero MotoCorp. Next stock is Bharat Forge. North America Class 8 truck orders for the industry are out. Now the orders have continued to see a decline for the consecutive 3 to 4 months. The orders have been declined, and now the orders for the month of March have come in at a 7-month low. That is the lowest since August 2024, and these orders are down both month on month and year on year. ACT Research, the agency which publishes the data, they are mentioning several reasons of this decline in the order, and some of them are: first one is policy uncertainty, and second reason that there is a moderation in the economic activity as well. So these are some of the reasons that they have pointed out, and because of that orders are declined, and I'm going with red for both these stocks because of these factors.
Okay, all right. Thanks a lot for that, Sudarshan. Well, let's hop across to Mangalam. Mangalam, plenty of talk of what's going to happen to the US consumer. For the time being, Dabur's numbers indicate that the domestic consumer as well isn't doing too well. Dabur's numbers, volume numbers subdued again.
Well, that's correct. So a stock that I'm tracking today has nothing to do with the tariffs, but it's spooky nevertheless, and that's Dabur. Consumption in India hasn't picked up as per Dabur. In fact, they say that FMCG volume trends continue to remain subdued in the fourth quarter itself, and they are likely to see a mid-single digit decline in the India business, as a result of which their consolidated revenue in the fourth quarter will be absolutely flat. And what are the reasons that they are attributing to this weakness? One is delayed winter, secondly is urban slowdown, and the third part is weakness in general trade, which has impacted their India business, as a result of which they'll also see 150 to 175 basis points contraction in the fourth quarter EBITDA margins. Now, what remains to be seen is it a Dabur specific issue, or does this percolate down to the entire FMCG pack? Because over the last few quarters, Dabur has been underperforming the other FMCG companies, and the company has been promising better times but not delivering them. Post the third quarter, they said that consumer sentiment has bottomed out. They'll only see improvement from here. In fact, post the second quarter also, they said that the second half will see mid to high single digit revenue growth. That's not the case to be. So whether the street, ignores what the management has to say and react to what the management does is something we'll watch out for. For starters, the stock in the red today.
Got it. All right, Mangalam, thanks for that. I'm looking at Hindustan Zinc, and going with red more to do with what's happening in the globe rather than with regard to the operational performance. But the reason we're highlighting the stock is because of the quarterly operational numbers is what they've given. On a quarter-to-quarter basis, actually, there is an improvement. But otherwise, if you look at the saleable metal production, it's down by around 1%. The zinc production, that's down by close to around 3% on a year-on-year basis. And the lead production, that's marginally up. But because the headline number, that's a saleable metal production number, is still lower on a year-on-year basis, going with a tinge of red on this one. That said, let's hop across to Abhishek. He's tracking a few banking and financial names. Morning, Abhishek.
Morning, Nigel. So to begin with, some of the business updates of lenders have come out. PNB over there, weak business momentum seen. Deposit growth is at 14.3% YOY, but just 2.4% quarter on quarter. So quarter on quarter, it's the weakest growth that you are seeing in last 5 quarters. Domestic deposits are up 13.3% YOY and about 2.4% quarter on quarter. Advances growth are at 13.6% YOY and about 0.64% sequentially. So YOY is the weakest growth that you are seeing in last 4 quarters, and sequentially quarter on quarter, it's the weakest growth that you are seeing in last 15 quarters. Domestic advances are up 13.2% YOY and about 0.6% sequentially. Calculation shows that the CD ratio, credit deposit ratio, has declined both YOY and quarter on quarter. M&M Fin, now Q4 is supposed to be a strong quarter for them, but we are seeing weak disbursals over here. So disbursals are up just 1.2% YOY and down about 5.9% sequentially. The total assets are up 16.5% YOY and about 3.8% sequentially, suggesting that the tenure of the book might have increased. Now, stage 3 has improved by about 23 basis point quarter on quarter. Stage 2 has improved by about 80 basis point on a sequential basis. Collection efficiency has improved on a sequential basis, but has declined on a YOY basis to 97% versus 101% YOY and about 95% sequentially. Liquidity in the balance sheet has been shored up, so it's now at 10,000 crore, up nearly 10% quarter on quarter, and forms about 8.4% of the total assets. AU Small Finance Bank, they have met their annual guidance for growth. They had given out a growth guidance of 20% and they are at 19.9%. Robust deposit growth also seen over here on a sequential basis. Deposit growth is nearly 10.7% quarter-on-quarter. Advances growth is at 7.7% sequentially, while AUM growth is at 6.2% sequentially. The CASA has also improved over here. So overall, the CASA growth is at 5.5% on a sequential basis, but CASA ratio has declined as other deposits have grown massively. Back to you.
Okay, all right, got it. It's a bunch of financials. We'll watch out for how the stocks react to those business updates. Thanks for that. Let's move to Upasna. She's watching out for a few stocks, including, I think, BEL and Kirloskar Oil. Upasna, good morning.
Good morning, Surabhi. First up, let me start with BEL. Yet again, this stock will remain in focus today as well on the back of its order win. The company has signed contract worth 593 crores with Indian Air Force. This contract is mainly for providing maintenance services for Akash missile systems. Also, company has indicated that it has concluded negotiations with customers for orders worth 5,000 crores. Now, next up is Kirloskar Oil Engines. The company bags order worth 270 crores from Defence Ministry. The company will design and develop in-house speed engines scalable from 3 to 10 megawatt. While these engines will be mainly used for propulsion and power generation on the ships for Indian Navy and Indian Coast Guard. So all in all, these two stocks will remain in focus today. I expect both of them to open in green on the back of the order win.
Okay, all right, got that. Thanks very much, Upasna, for those. Let's get across to Vinny. She has a few names on her radar as well this morning. Vinny, good morning. Tell us.
Good morning. So firstly, we are just going to talk about Mahindra Lifespaces. Now, they have won a redevelopment order. This is for 2 residential societies in Andheri West. So yes, they have the premium location coming in. Approximate value of this redevelopment project is 1,200 crores. And this will be under the state's cluster development scheme. So yes, this is a partnership with that. And a big one coming in for the company. In the recent times, they've got a lot of new order wins as well. So in terms of the redevelopment side, as well as in terms of development projects. So interesting to watch out for Mahindra Lifespaces. We're expecting green here.
Okay, all right, got it, Vinny. Let's quickly then recap our list of stocks to watch. The ones that have positive news flow around them are Bharat Electronics, Kirloskar Oil Engines because of the orders, Mahindra Lifespaces, AU Small Finance Bank. These are the ones on the green side, but on the negative side could be Hero Moto, Bharat Forge, Dabur, Punjab National Bank, M&M Finance, and Hindustan Zinc.
Okay, all right, time to slip into a short break, but our coverage on Trump's tariffs continues on the other side. Stay with us.
April 2nd, 2025 will forever be remembered as the day American industry was reborn, the day America's destiny was reclaimed.
Welcome back. So we're getting up or gearing up for the roller coaster. The implied open has been telling us that we'll probably start about 250 points down in line with how the Asian markets are reacting. By the way, Dow futures at one point in time, they were down 1,000 points, now down about 850 odd points. So US futures are also sharply lower. What does this tariff storm mean for India? Let's get the conversation going. We have with us Amitendu Palit, Senior Research Fellow at the Institute of South Asian Studies at the National University of Singapore. And we also have with us Sanjeev Krishnan, Chairman at PwC, to take this conversation forward. Thank you, gentlemen, so much for joining in. Morning to both of you. So, Sanjeev, opening thoughts. Trump is trying to shift the world. He's trying to get American manufacturing back. But in the process, there's a lot of chaos. What do you make of the new tariffs that have been announced, particularly on a lot of the Asian countries, including India?
So I think the first thing first, I think this is obviously from a US standpoint, they are doing what they believe is good for them. I think from a Southeast Asian perspective, and particularly from an Indian perspective, I don't think there's need for us to be too disheartened, I would say, because this is something which is going to happen to multiple countries, and as we have seen in the news that came in last night, multiple countries are going to get impacted for it from the tariffs. Now the question really is that what is our competitive advantage, and I think that's what one needs to focus on, because let's take imports into the US coming from Southeast Asian countries, etc. It's not only that India has been put on tariff, China, Vietnam, where the supply chain, the elongation of the supply chain was really impacting imports into the US. I think all of the countries are getting impacted. So for us, I think the broad framework really from my standpoint, as we see it, really is that we need to focus on our competitiveness on a go-forward basis. A few days back, we came up with what we call an ideas framework, which is where we need to be able to continue to invest and also diversify our export portfolio to make sure that India mitigates the impact of some of these tariff regimes, which of course any country, in this case US, will continue to do in what they think is best for them.
Absolutely. No, take your point entirely, Sanjeev. I think the first order impact for India is not that great, but it's not that big, but it's the second and third order effects that I think we're far more worried about. Let's get your thoughts in as well. So take Sanjeev's point entirely that I think, and for us, for now, for instance, pharma has been spared, others are being tariffed a lot more. But the issue is if the US consumer itself starts consuming less because commodities across the board, products across the board are getting more expensive, then there is a hit on US growth, global growth, and then there is a market, storm to deal with as well. Equity markets overall, financial markets freezing up as this chaos plays out. So how significant would the second and third order effects be?
Thank you, Surabhi. I think a real pleasure for me to join on this show and quote unquote best greetings on what is being called the Liberation Day by President Trump. I would bring in 2 points to the thought that you shared. The first is that you did mention about the impact this is going to have on the US economy domestically, what's going to mean for the US consumers. And I think to that extent, President Trump has already made it pretty clear in a few interactions that he has had over the last 1 month that there is going to be short to medium term pain for all the measures that he is bringing in. So it's in a way sensitizing the US consumers about the fact that, look, tough days are ahead, but they're all for a better, brighter future. The American dream is going to come back. So that's his domestic narrative and rhetoric. What it means otherwise is obviously very significant. The United States growth is going to shrink. And it's not just the United States growth that is going to shrink. There is going to be a contractionary effect across the headwind inflation trajectories in many parts of the world because the supply chains are going to get badly impacted. But more importantly, Surabhi, there's one point I want to draw your attention to. If you look at the tariffs that have come, the tariffs are not just tariffs. They are tariffs including trade barriers and currency practices. That's the heading on which this has been announced. And it's very interesting. If you, for example, it's very ad hoc in character. If you look at a country like Turkey has been called out twice in the executive order because of the high tariffs it imposes on rice husk and apples. Yet, if you look at tariffs, the reciprocal rate for tariffs on Turkey is very small. It's just 10%. Whereas for many other countries, the rates are much higher. Now, this, I think, is where the crux of the matter lies. These tariffs are going to be bargaining chips by the US administration for taking out extracted concessions from its partners on several other areas, which could be with respect to currency practices, which could be with respect to many other barriers. I think specifically for India, there are 2 areas of concern. The first is the quality control orders, which have been very reflected upon in detail in the foreign trade barrier report that was brought out 24 hours before the reciprocal tariffs in number 1. And number 2, India does figure among the list of countries which the US administration considers are currency manipulated countries. So I think these are the 2 areas, and also subjects like government procurement markets, where the US would expect concessions. Those are difficult policy areas for India to address. I think that's where the real risk lies.
Absolutely. No, a point taken. Good morning, gentlemen. To the point of how they've arrived at these numbers, Prashant here, it looks like what they've done is they've taken the deficit, divided it by the imports, and that's how they've got to the number. So, the deficit with India is about $46 billion. US imports about $88 billion. So about 46 divided by 88, that's the 52% claim tariff number. So, I mean, if this is true, and many are pointing out that this is how they've arrived at that number, it's I don't know, I mean, what to make of it. But specifically, Sanjeev, if I can ask you, there are many who are saying that for countries, for sectors like textiles, Bangladesh is hit higher, Vietnam is hit much harsher. How would you respond to that? Because I'm assuming cost of making stuff in those countries is lower, and it's also easier in that sense, widely acknowledged. So is that actually a silver lining that they are hit harder than us with regards to specific tariffs? Go on.
Well, I mean, I would say that, so that may be true. I certainly won't comment on what's happening there, but I would only make one comment. Inefficiency in production anywhere, if that is leading anyone, could be us, could be anybody else, to do better in the short term. That's only going to be in the short term. I think the important thing really is that it's a call for Indian industry to become a little bit more efficient. And in some ways, I think it could be a paradigm shift in the way we look at our manufacturing over the years, etc. If manufacturing has not been our strongest space so far, it's again a call for action that, okay, figure out your logistics cost. Start thinking that scale is important, and big can be beautiful and big can be better, because some of those will give us the efficiencies that will make sure that we are even more competitive in the global markets. You are right that in the short term, India possibly may not suffer as much because there have been greater tariffs on some of the other neighboring countries that India has, particularly in the segments that you mentioned. But that's going to be only a short term thing, and as is being said, some of these are going to be used as bargaining chips. I think from an India standpoint, I also feel a little bit more confident because we all know that a BTA is being negotiated at this point in time. Possibly the only country, at least to my mind, India is the only country with which US is actually negotiating a BTA at this point in time. So I have a lot of hope from that standpoint as well. But I mean, again, the moot point, and that to me is the underpinning. It's a call for action for us to be a little bit more efficient and to make sure that our trade interests are protected, which I'm sure the government of India is doing at this point in time.
Yes, absolutely, gentlemen. I mean, back channel parlays will definitely, take place, and let's see where this eventually ends. Thank you so much for joining in with some opening thoughts, at least, on this very, very busy morning and very, very chaotic morning, might I say, from a market standpoint. Just want to point out that our teams have verified the official White House document is actually putting India's tariff at 27% and not 26%. The placard that President Trump was holding up and whatever he tweeted out on social media, there the number was 26% for India, but the official release from the White House, which has tariff lines for a lot of countries, including us, the release there talks about a 27% for India. So just putting that on the table. Let's take a quick break on that note. Come back on the other side. We'll, of course, have our technical experts joining in, also Deepan Mehta joining in for some fundamental ideas.
Welcome back. You're tuned into Bazaar Morning Call, and let's get straight to some fundamental analysis. Deepan Mehta, Director Elixir Equities, joins us on the show. Hi, Deepan. Good morning. Hope you got enough sleep last night. President Trump was, shooting out the tariffs, and a lot of investors were a little bit jittery. But now at least that uncertainty is partly out of the way. So let's focus on the markets and let's focus on stocks as well. Deepan, today for starters, the pharma stocks could start off in the green. And late in trade yesterday, you did see a surge actually. So that told you that the pharma index itself, had a bit of a sniff that maybe nothing is coming for them, nothing negative, at least as of now. Your view on the pharma stocks, and do you think that they'll get away, or do you think that given the uncertainty, you rather stay away?
Good morning, Nigel, and thank you for having me on your show. I slept through the entire announcement. You can always catch up in the morning, but I think it's a great sense of relief for the pharma sector. And I think pharma stocks again will come back into the reckoning. I don't think that having announced this kind of an elaborate tariff policy in place, that they should start tinkering with it very soon. So I think pharma has a clear run for the next several quarters or so. And clearly, I think the Trump administration recognized the fact that pharma provides a very important, it's a very important import for US, considering that it keeps the healthcare costs lower. So from that point of view, I think it's very positive. I would focus on some of the CDMO players, I think, where the prospects look really good, although they are trading at expensive valuations. But I think growth rates will be higher over there because they have an advantage against Chinese when it comes to this particular activity within the pharma space. But on the whole, my first reading is that it may create opportunities as well. And we'll have to go company by company to understand how these tariffs are playing out for them. And there could be a few surprise winners as well. Could be even textiles, who knows. So I think this entire earnings season will be quizzing all the managements on what they make out of this Trump policy.
Deepan, I mean, absolutely take your point on pharma, etc. And a great space. Numbers for the fourth quarter should be pretty solid, etc. as well. I just want to make it's just one caveat. The executive order excludes reciprocal tariff goods that are subject to or that will become subject to sectoral tariffs through Section 232, which is their National Security Act. And this includes pharma. So the only thing is that sector level tariffs may still yet come. They're not come as part of this. It was not on the agenda last night. So that is the only caveat. But I mean, I take your point in that sense. Maybe a bit of a relief at the margin. But otherwise, I mean, it's not great news at all, right, Deepan? For world markets, for at least in the near term, economies, trade. I mean, a fair bit of disruption and turmoil in that sense. Beyond what happens today.
Prashant, I see this as an opportunity. And if you go back into our 20-30 year history, whenever there is turmoil in global markets, and if you buy Indian stocks in 2-3 years down the line, you get exceptionally good returns. And in a way, a lot of Indian companies that we are investing in are completely insulated from all these global trade. If we look at the banking sector, infrastructure, cement, retail, entertainment, hospitality, I think they are not affected by what Mr. Trump says. And investors are focusing on those sectors. So if you consider the entire listed space, apart from pharma, IT, textiles, specialty chemicals, there are a lot of sectors where investors can have there's no certain uncertainty around these Trump tariffs. And such events, they provide a good entry opportunity. So if you're sitting on cash, you've not taken advantage of this recent rally which has come through, then this is a great time to invest. And I think investors should consider the history. Whenever there's turmoil and you have bought, you've always made a very good return.
So far, there is going to be turmoil in trade. Is there turmoil in stock prices? Maybe not yet, right? You would agree. Starting points matter. I mean, it's not as if they're not wildly off in that sense. It's not like one of those big global financial crises which have brought prices sharply down. But anyway, Deepan, what is on your mind? 2-3 ideas which really, to your mind, stay insulated from all this.
I think that NBFCs are looking very interesting to me. With usual disclosure, I think stocks like Bajaj Finance, L&T Finance, even beaten down stocks like IIFL Finance. So within the banking space, I think there could be several triggers for NBFCs, starting with interest rate cuts. And we have this lower risk weightage, so that's looking good. After a long time, I think retail also looks quite interesting. Specialty retail companies, the likes of Campus Activewear, Metro Brands, Go Fashions, Ethos, I think all of these companies have had pretty soft quarters. Even tier 2 retailers like V-Mart, we saw what numbers they declared in terms of their same store sales and overall sales, very impressive. V2 retail, I think. So that looks quite interesting to me. And like that, I think many ideas are there. We spoke about cement also, ACC Ambuja, I think they have a good run. And after a long time, we are seeing a lot of flow of orders to the infrastructure builders and to the defense sector. So I think it's business as usual over here. And although I agree that stocks are not really at throwaway valuations, but you may not expect multi-bagger returns. but at least you can expect returns which are, typically historically, what we have got historically in the Sensex and Nifty, which are around 12 to 14% or so.
From the companies that have won orders, which any particular names you like? Very quickly, Dipan.
Hindustan Aeronautics, I think, very good visibility over there.
Okay, all right. Thanks for that, Dipan. Stay with us. For the time being, you slip into a short break. Come back. We'll get you pre-opened rates. We'll also be joined by Sudarshan Sukhani as well as Mitesh Thakkar. Stay with us. Welcome back. This is Open Exchange. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. Well, as promised, let's get in our technical guests. We have Sudarshan as well as Mitesh that join us on the show. Good morning, gentlemen, and thanks a lot for joining in. Well, Mitesh, you go first. A 300-point gap down. What do you do?
Yeah. So, morning, Nigel. I think, while the GIFT Nifty is indicating about 300-point kind of cut, I'm hoping it limits itself to about 200, 220. So basically open near yesterday's low. If that scenario plays out and then, we don't break below that, then I think after some choppy first couple of hours, we might actually recover. Because the structure to me on the daily and the weekly charts is still positive, especially on the Bank Nifty. So I'll keep a watch over there, and banks will not be directly affected by the tariffs. So I think I'm hoping that the Bank Nifty could lend some strength on the upside to the Nifty and we could hold on. In case the Nifty starts breaking below the levels of 23,100 and close below that, then I think I'll be slightly skeptical and would be keen on reducing our long exposure.
Okay, so you're not looking to buy the initial dip. You'll observe the first hour of trade and then you'll take a call. Is that correct?
That's right.
Okay, all right. Sudarshan, what about you?
Good morning. Well, I'm very clear. Yesterday I said do not trade. There is far too much confusion in the market. And yesterday we all knew that the Trump announcements are coming. So there was no way we could have taken a trade on the long side or the short side. Doesn't matter. Today the same view continues. See, the markets hate uncertainty. So half of the uncertainty is over. We all know what kind of tariffs have come. But the other half still remains. How will it affect us? How will it affect a sector? Will it be good for this one? Will it be bad for this one? Will it affect Japan and then help India? I mean, I don't have the answers, but the market will find these answers in a few days. It won't find it at 9:15 today. So that half of the uncertainty remains. There is no sense in dabbling in a market if it does not know which direction it wants to go into. In a few days' time, we will have much more clarity whether we are going lower or whether we are building a base. But today is not a day to trade.
Okay, so sitting out at least at an index level. Got that. Gentlemen, morning. Let's also talk about stock trade. Sudarshan, so are you saying no trade at all or only index? Are you trading any stocks today? What's the recommendation?
It's no trade in the index. There are some trades always in stocks. So Ashok Leyland is an intraday short, stop above 210. HCL Tech, another intraday short with a stop above 1550. I also have Dr. Reddy's as an intraday short, but now I've been hearing you and maybe traders should be careful before going into this short position and maybe it'll work out with a stop above 1180. My only buying idea is GMR Airports, and there it's not an intraday trade, but I think there's a positional buy here. So keep a stop at 72, adjust the stops according to the gap down, but stay there. And primarily intraday shorts is what I'm looking at.
Okay, intraday shorts, got that. Mitesh, what about your stock list for the day?
Well, I need to apologize. I think there's some problem with my computer. I'm not able to switch and it's got on hang mode, just the Zoom meeting.
No worries.
Allow me a few minutes to come back with this.
Yeah. We'll come back and take your stock trades in a bit. In the meantime, let's also get Deepan's view on Dabur. Deepan, while we're all very worried about this whole global storm playing out, I'm more worried about, hearing Dabur. Look at how negative their update was for the fourth quarter. Talking about a margin decline, talking about a mid-single digit decline in the India FMCG business, no pickup. Your thoughts on the stock?
Yeah, Surabhi, we've been very negative on FMCG for a long time. And I think we have to move away from FMCG stocks, considering that volume growths are very tepid for the entire sector. A lot of products have reached maturity phase. And I think, investors who have been in these stocks for decades, and they've been great multi-bagger stocks in the past, need to move on. And there are many other, stocks within the consumer investment theme which they can play, but definitely it's not FMCG. Even at these levels, I would consider exiting FMCG stocks, although they haven't rallied much and they have underperformed for the past several quarters also.
Okay, all right. Deepan, good getting those thoughts across. Let's welcome in our next guest, right? Sharp increase in oil imports from the US. Prabal Sen is energy analyst at ICICI Securities. He's with us now. Prabal, good to have you with us here. It's the start of what is going to be a long and tough day. What did you make of it? Any implications for your sector with these tariffs last night?
I think the language suggests that energy, so far at least, has been kept out of the ambit of the tariffs. I still don't know if the 10% flat tariff that has been talked about, in addition to the reciprocal tariffs, we are trying to get a view from the companies whether the petroleum fuel exports to the US will be impacted by this 10% tariff. But at least the higher reciprocal tariff don't seem to be applicable to the energy segment as of now.
Okay, no, absolutely. It is not applicable. But any other roundabout implications from a stock perspective, not business-wise, Prabal?
Well, I think, frankly, more experienced people will be better at commenting on the overall impact that will be there on valuations and multiples across the board. I don't think this is something that anybody has been prepared for. Obviously, you have been expecting that this tariff order will come, but an impact on the broader market will obviously singe every sector, not just mine. The benefit or the small positive, if I can eke out, is that multiples for our sector, specifically the oil and gas sector, are not really anywhere near, premium multiples across the board. So to that extent, the possibility of a further derating or a structural derating is relatively less. The second aspect is that, peculiarly enough, the concerns around global economic growth can have an impact on slightly lower energy prices. And India being a price taker and a major importer of crude oil and other gas inputs, there I think the margin improvement can actually help, offset any impact on volumes or growth that may happen with disruption in export volumes or, any other spillover impact that one might see. So I would say that impact definitely will be there. But as of this moment, I think the oil and gas sector is the least of our worries.
Absolutely. You said it, Prabal. Now, I'm just actually looking at, just allow me 1 second. I'm looking at the first pre-open rates that have come through. So 182 points down on the Nifty. It's pharma all the way. All your pharma stocks are pushing higher. Divi's 4%, Dr. Reddy's 3.5%, Lupin 4.5%, Aurobindo 6.5%, 7%. Gland Pharma, Glenmark, you name it, Gland is up about 12%. So mid cap, small cap, large cap, all pharma. Generics players, CDMO players, all kinds of pharma stocks are ripping higher this morning on this relief. At least they've been spared for the time being. And we'll talk about pharma as we go forward in just a bit. But probably just my quick question, as the market goes through this turmoil, it will require all the help that it can get. So from that standpoint, I don't know if Reliance can do its thing. At least on the oil and gas business side, do you see any positives up ahead as we're going to be looking at the fourth quarter numbers and looking forward? Overall GRMs, given what's happening in the oil and gas markets. So can we expect any help from RIL?
I think for RIL, I think the performance of the OTC business.
I think we've just lost that line with the Prabal. We'll try reconnecting. But it is really pharma along the way. Dipan, let me ask you about this pharma surge. Right now, it's, you buy everything on a morning like this, right? It's a quick trade. But if you were to kind of stick your neck out and be a little picky and choosy from a portfolio standpoint on pharma stocks, then would you stay with large, generic players which have US presence, whether it's a Sun Pharma, whether it's Reddy's, etc.? Would you go with CDMO players? What would the more nuanced approach to pharma be for you?
So I think, again, Sun Pharma comes back as a part of your core holdings. And with this uncertainty, rested for the moment, I think Sun Pharma's strategy for the US markets and rest of the globe is very innovative, different, and will yield rich results going forward also. And looking at some CDMO players as well, I think, but they're very expensive. So waiting for correction, stocks like Suven Pharma, Divi's Laboratories, and even OneSource, I think are pretty interesting. There's this Blue Jet Pharma also, which is quite an interesting company. So I think that within the pharma also, eventually investors will try and get a bit selective and go for companies which have a superior business model.
All right. Any quick take on some of these EMS companies, Dipan? If the tariffs are higher on Chinese imports, maybe that throws up a bit of an opportunity. Some of them have seen a sharp correction as well. You think so? Or you want to stay away, given the high multiples that they've given the low margins as well out there, and given the run-up that we've seen in the last few years?
See, I think there's an opportunity, and as I said earlier, that as the dust settles down, it may make sense for some of the Chinese players or other international multinational companies to start operating or sourcing from India as well for the US market. So let's just wait and watch. Nothing specific comes to mind as far as EMS is concerned. But yes, I think I was quite impressed with Syrma SGS's numbers, and the management commentary also is quite positive. The stock has corrected significantly, and now at least trading at valuations which kind of makes sense if it can grow at that 25-30% type of clip for the next few quarters or so.
No, got that. Deepan, thank you very much for joining us. Good conversation, and I hope we speak again soon as we navigate through the day. By the way, at least the start at the pre-open is now come to an end. I think I saw 0.78%, 0.8% kind of a cut. Which is, 180 points. You're basically just reversing what you gained yesterday in that sense. So 23,150 or so is where we are starting at. I think let's get Sudarshan in 9:10 call. Sudarshan, what do you have?
Well, GMR Airport is a buying opportunity with a stop under 72.
Okay, GMR Airports with the stop under 72. Aditya Khemka is now with us. He's fund manager, Intred Asset Management. Aditya, good to have you with us here. Good morning. Let's just talk about pharma, which is seeing a bit of an uptake. So it's been spared, but should we say for now along with it? Because if you read the executive order, it's part of sectors which are included under this national security thing. So sector level tariffs may yet come. What's your sense?
Yeah, hi, good morning, Prashant, and thanks for having me. I would agree with you. I think you should say for now because, historically the Trump rhetoric has been to include pharma as a part of their tariff on India. And, sooner or later, my belief is that pharma will probably fall under the tariff situation. And it is a national security issue. Remember, Indian pharma companies export anywhere between 50 to 60% of the volumes of medicines in the US. So, from that standpoint, if the US were to take a stance that, are they vulnerable to India stopping medical supplies to US, would that become a national security issue? Yes, it would, because 50-60% of your volumes would evaporate. So, tough to believe that it won't happen. But when and how and in what shape is something that we don't know.
Okay, so Aditya, I'll ask you the same question I was asking the previous guest as well. In order to try and play this the smartest way, because we don't know what President Trump does tomorrow, whether he imposes certain new conditions on even pharma exports that are coming into the US. But what would be the best way to play this? Should you stay with CDMO players? Should you stay with players who have a great specialty generics pipeline, maybe specialty products like Sun Pharma? What would your personal preference be?
So personally, we are more focused therefore on companies which have nothing to do with US. To be honest, we are focused on hospitals, diagnostics, Indian focused pharma companies, be it your Tollent, your Alkem, your RPG Life Sciences, your companies which are more focused on India and less to do with the US. Same goes for any hospital business or diagnostic business which is listed. They have nothing to do with the United States. So if you have to take exposure to healthcare, you are better off, looking at these kind of stocks because they don't have the exposure to US to have a risk. Understand as a fund manager, when we think about this, the entire tariff angle, whether it happens, when it happens, at how much rate, we don't know. But there is an added risk now to owning the stocks which have exposure to the US. Is there an added reward in owning them? The answer is no. So if there is no added reward, but there is just added risk, it just doesn't make sense to keep owning them. That's the whole perspective here.
That's an interesting point. Yeah, today we could get that relief rally, but this isn't over. And you have no idea what comes on pharma as well in the coming weeks and days, perhaps.
So to say for now, is relief, and that's essentially the point. But well, we'll take what we get because otherwise fewer places to hide in that sense.
Yeah.
But it's just, day one, right? There'll be, I think Neelkan made a good point, a thing which we can all understand. He put it in the parlance of a street fight. But the question to him was, can this all be reversed if a new president takes on? And he answered it by saying, if you slap someone, they slap you back. Then you kick someone, they kick you back. Then you punch someone, they punch you back. And then you say, well, let's go back to how it was. It doesn't work like that. And, so it's like a starting point. And I think we'll see a lot of moves going forward over the next many weeks and months as well. So the opening rates are on your screen. 23,180 is where we are at. It's 150 points lower. It's basically just a reversal of what we saw yesterday. It's not severe by any yardstick. It's like any other open. 0.6 lower on the mid-cap index. The small-cap index is down about 0.33% or so. And the stocks are all coming up on your screen. Pretty normal kind of a session, right? 3:1 is the declines to advances. So more down than up, and that's understandable. But for now, at least at this point, it's okay. So 260 lower on the Nifty Bank as well. That's the rate which is coming up. Let's talk about stocks, Surabhi.
Yeah, absolutely. Not bad at all compared to the declines we've seen across Asia, thanks to the fact that we're a domestic-facing country. Speaking of domestic, Dabur, 5% lower. That's the one that's taking it on the chin because of the poor Q4 update. Let's talk about Nifty stocks then. IT is weak. There's no denying that, no taking away from that. And that's the sector that's getting hit the hardest this morning. Wipro, HCL Tech, TCS, Infosys. Look at all the IT stocks. The cuts are anywhere between 1% to about 2.5%. If you go in the mid-cap space, and the cuts are even bigger on stocks like Persistent, LTI, Mindtree, Memphis. So a very clear downtrade today is IT. It's across the board down. Okay, let's move on. What else? Stocks like ONGC, Zomato, Hindalco, they're all on the weaker side. Financials are not able to provide too much support, at least not right now. HDFC Bank, Shriram Finance, these are all stocks on the lower side as well. Let's look at some of the other names. Reliance, let's see what Reliance is doing. It's down about 0.7%. ICICI Bank also down about 0.5%. L&T, slightly lower. L&T is actually very close to the flat line, so let's see. On the upside, obviously, as you would expect, only Pharma and Pharma. Dr. Reddy's 5%, Sun Pharma 4%, Cipla 4%. And a bunch of PSUs are actually having a good morning. They're outshining on a day like today. NTPC, Power Grid and BEL. All these stocks are seeing green.
Well, that's right. I think the IT pack is getting hit, and particularly mid-cap IT pack is getting hit on the back of US recessionary fears. So take a look at some of the frontline F&O counters. You have Persistent Systems, KPIT Technologies, both of them are down. Coforge as well is down close to around 2.5%. On the flip side, just to name a few of those pharma names, should be mentioned a few. Gland Pharma and Piramal Pharma from the broader markets, both of them, they are bucking the trend. They are some of the big outperformers this morning. A few other notable names that are moving around. Well, you have Sharda Cropchem. That stock is down close to around 7%. So there may be some kind of worry on that front. So that stock, in fact, is a little bit lower in trade. A couple of other notable losers. You have L&T Tech Services. That stock as well is lower. But as we are doing that market check, I'll tell you what, the markets have cut their losses now down to close to around 100 points. The bulls will say this is something that we like, at least for the initial minutes. And if you can put the crisscross lines in just a few minutes into trade, from around 300 stocks that are advancing, now you have 900 stocks that are advancing. Good going. Mid-cap index recovers from the low point of the day.
What are we talking about? It's a normal day.
I was just thinking, Surabhi, yesterday during closing, I think we were chatting on how tomorrow we could see a relief move, right? And I said, well, we're saying this with the risk of being immediately proven wrong. But can you be wrong and still be right? Look at the...
This is not bad at all. I mean, this could be a regular day. Absolutely in the market, for now at least.
And I think it'll be interesting to see the foreign number, the flow number, because is this retail once again sort of piling in a big way and supporting things and sort of buying this... And of course, I mean, I think for today, the foreign sort of activity will pick up as we go through the paces through the course of the day. So I think it's just still the initial kind of first reaction which is coming through. And so we'll have to give it time. Yeah.
Also, foreign managers will have to, they have a lot more to think about on their other positions in China, in South Korea, in these countries which have been slapped hard.
I think, just to give you a couple of technical levels, on the Nifty Bank, it's good to see the 200 DMA has got protected, and on the Nifty, the 20 DMA, at least as of now. You'll want both those two levels to get protected, and gives you some hope that we'll see an additional fight from here on. Expiry day as well, so things can get volatile in the final couple of hours of trade.
Absolutely.
Absolutely. And, lots to track as far as specific stocks, etc. are concerned. But let's just actually put maybe just a few other names, right, up there for our viewers before we bring in our next guest. Do we have our market master with us? And I think we should be able to go to them in a bit. So, yeah, I mean, it is all pharma. The biggest volume-led gainers are Oro, Dr. Reddy's, Lupin, Sun, Cipla, Zydus, Gland, Divi's, Piramal, Laurus. My God, Glenmark. It is between 3 and 9% gains, and we should actually have those up at the bottom of the screen. So this is the biggest volume-led. Mankind, you can throw in Marksons, you can throw in Newland, you can throw in Moripun, you can throw in Supriya Life Sciences, 3.5%. And I'm not looking at some aggregation of pharma stocks, but I'm just looking at, I've just sorted the biggest volume-led gainers as far as the NSE is concerned, and this is what is coming up. About 10, 12 names, but all from that one space, at least for now.
Absolutely, yeah. So not too bad. Now, how is the Indian side getting ready for its response? Sources have been telling us that Indian officials are right now analyzing the impact of the differential and reciprocal tariffs. We have our colleague Abhimanyu joining in. He's been working the phone lines to see. Till now, no official response from India. We've seen that from a lot of countries. We've seen that from the EU, Australia, China. Not yet from India. Abhimanyu, what's the latest?
India is analyzing the impact of differential and reciprocal tariffs. Now, these tariffs are going to kick in two phases. The first phase would be 10% of tariffs kicking in from the 5th of April. And additionally, 16% of tariffs are going to kick in from the 10th of April. What sources have indicated so far that the government is studying the impact, is analyzing the impact, and it has also indicated that differential tariffs will mean a mixed bag for India, which means gains in some sectors and also losses in some sectors due to variation in competition with several countries. Also, sources have indicated that the clause 4 of the American order clearly says that the American president retains the power to cut tariffs with countries which are going to address the American concerns. India is already engaged in BTA negotiations with the United States, and both the countries aim to conclude the first tranche of the BTA negotiations within 2025 itself. So India, of course, remains engaged in negotiations with the US, and what had earlier been indicated that sectoral level, expert level talks would start virtually in the next few weeks, and expert level engagements will also possibly pave the way for in-person talks between both the countries. It remains to be seen what is going to be the overall impact. A detailed statement would be issued possibly in course of the day by the government, replete with analysis. So all eyes, of course, would be on what is going to be the possible impact.
All right. Thank you very much for that. Sandeep Bhatia is with us, Managing Director and Head of Institutional Equities at Macquarie. And he's now joining us. Sandeep, good to have you with us here. Pharma, I want to just start with, I mean, any thoughts, any discussions with your team, especially with pharma, your pharma analyst in particular, on, the sector is seeing a big move.
I think it's good to see that the pharma has been exempted. I think what this means is that it's not the Trump administration not immune to domestic internal U.S. political pressures and requirements, and the pharma business is definitely integrated into the entire medical healthcare system in the U.S. So we remain positive on pharma. We like Sun Pharma, and this is. I think an indication of what should be taken as a broader message is that the tariffs that have just been announced are opening move, and there could be negotiations. India is already in bilateral trade agreement negotiations, and we could see changes in the tariffs for India and even for some other countries.
Gentlemen, I want to take just one moment to relish the fact that we've got, on a morning like this, we've got green on the screen. Look at the mid-cap index. It's already broken out into positive territory. Thank God for our founding fathers for always wanting to make India a very strong, resilient, domestic-facing economy, integrated with the world, but very strong domestically as well. And maybe that's what's helping us on a morning like this. That's the mid-cap index. Even the Nifty, 100 points down right now. Sandeep, so with that optimism, let me ask you the question on the broader market. As this tariff storm rages out and foreign investors have to decide what they want to do with their positions in other markets, like I was saying, China, Korea, Japan, could India be a beneficiary at all? Could they say India's maybe least impacted, relatively speaking, so let's allocate some money? Maybe it's a very simplistic question, but I'm asking you nonetheless.
I think it's a good question. I think India is in many ways an economic island. We have to appreciate the fact that we will be best placed to weather the storm. I don't think that India, both in terms of its economy and its geopolitical position, is at any way disadvantaged. I think we will see near-term pressures. The real challenge actually is not directly to India, but the entire political economic system and order is being overturned as we see. The real impact, therefore, on India will be the demand destruction that will happen globally. I think people will be very simplistic to assume that this is my exports and this is my direct impact. But remember that tariffs are going up not only for India, but tariffs are going up for other countries. And a lot of other countries around the world are significantly more globally dependent on exports to the US than India is. So I think the first impact is a very short-term direct impact, but the longer-term impact is on the entire demand, global GDP growth and trade will definitely suffer. The only other positive thing that can come from a slowing global GDP growth is energy prices may fall, but all this will happen over the next 6 to 12 months as things become clear what the final tariffs are. But definitely, as far as US is concerned, tariffs are up from where they were in 23-24.
No, absolutely, Sandeep. Take your point. I mean, the growth ramifications really need to be seen and they'll play out. But again, from a very near here and now perspective in terms of markets, would you anticipate more foreign flows?
I would think that right now is a risk-off moment. So to say that foreign flows will be rushing into India because of that, no. But yes, India will be least impacted of all the emerging markets. That much I can definitely see.
So you believe India will outperform from here on?
In terms of relative outperformance means that the rest of the market can fall apart, and if we are where we are, it's also good. So yes, India is an outperforming trade in the medium term, which is a 12-month scenario as far as I see it.
All right, Sandeep, shorter conversation today. Thank you very much for joining us. It's a pleasure having you here on CNBC-TV18. Well, it's now welcome in Neelkant Mishra, who's joining us this very busy morning, Chief Economist at Axis Bank and Head of Global Research at Axis Capital. Neelkant, good morning. Great to have you with us here. I'm sure you've been poring over the details and, of course, talking to your team and getting a sort of view out there. So I just want to get that view, Neelkant. I remember speaking with you 2 days before, 2 or 3 days back, and you said it's just going to be the opening gambit and it's going to linger. We won't get clarity and it'll go back and forth, but this basically means a lot of uncertainty. What has been announced is much harsher, Neelkant. Would you agree than what anyone thought?
Yes. The fact that the impact is not $300 billion, but closer to $700 billion is of course much bigger. The market should, I think, start getting used to the fact that uncertainty will now accentuate. So not only should we expect some countries to retaliate, we may also see significant currency movements starting to show up in the next several weeks. And and as the negotiation process kicks off, because remember that these are, they have deliberately started at 50% of what they think is the effective barrier. I mean, how it has been calculated, there are enough social media calculations on how simplistic it has been. But whatever be the case, they've started at 50 because I think the assumption will be that, look, we are going to raise it further if the negotiations are not doing well. If you start to retaliate, we'll raise it further. Either way, the estimate that I put out the last time we chatted, that about 1% of global GDP at the very least of investments can get postponed because of this. I think that estimate now needs to be revised further. The $700 billion odd of extra revenue that on an annualized level the US will start now to collect is about 0.6% of global GDP. So this is effectively fiscal tightening for the world. The US, of course, not all $700 billion will come from foreign producers. For example, if you take the smartphones, if production in China and Vietnam is going to be up more than 45 to 55%, or more expensive, and that from India about 25% more expensive, I mean, the US consumers will have to pay because there's not going to be any smartphone production in the US immediately. So there will be quite a bit of that $700 billion that will actually come from US consumers themselves in the form of higher inflation. And frankly, it's only through higher inflation that tariffs actually become effective on what the US government is trying to do. So, but the US government will have some tools to provide some solace, some assumption, some comfort to the US consumers through some other tax cuts. But the gist is that this is a straight first shot 0.6% of GDP, global GDP. The postponement of production would be another 1%. I think we are talking about a significant rise in uncertainty for financial markets.
Nilkant, sorry, just to get those figures in, 1% hit to 1% hit to US GDP, right? Or global GDP?
Global. So
1% hit to global GDP.
Because of postponement of investments.
Okay.
In addition to what is actually a 0.6% of global GDP tax that the US is now collecting or wanting to.
Okay. And you briefly mentioned that enough social media posts about how this number is being calculated simplistically, etc. We had an ING economist in the morning who said, well, and he used the word, not I, he said fabricated number. So they divided the deficit by imports and arrived at that 52%. Is that really so? So they're taking the size of bilateral trade, the overall bilateral trade, and it's got nothing to do with tariffs per se, the rate of tariff. Nilkant.
So if you plot the gap between MFN, see the executive order talks about how this started around 1934 when the US government started to have bilateral agreements, and then over time it transitioned into a global agreement, and there was a most favored nation MFN rate that was being offered that is not any consistent, and so that is how the justification is made. But when you look at, and therefore India actually on this is slightly better off because India's MFN rates were much higher than the effective tariff that has been imposed. Like India, it was 17%, but the tariff, they have calculated is about 45-50%. In Vietnam, where the effective MFN rate, average rate was 9%, their effective rate is 81%. So, which is why I think there are various other factors, and I don't think it is possible to quantify the impact of non-tariff barriers very efficiently. So some of the speculation on how this may have been calculated is right, but remember that the objectives remain the same, which we had discussed the last time. Multilateralism is over. The US does not want to get hollowed out industrially, and the dollar they want to depreciate, though I don't think this is going to help. And thirdly, that they want to generate out of revenue out of imports. So all of those three objectives are what I think we should solve for.
Okay, got that. By the way, Nilkant was talking about currencies, so I'm just taking a very quick look at what the currency markets are indicating, global markets, and there are big moves playing out. Look at the yen. The yen has surged, which you would expect because of the risk haven, the risk of nature of trade. The yen is now quoting at 147 to the dollar, and that's a straight move of 1.3%. That's the kind of rise the yen has seen. The euro is stronger because the euro as a bloc is coming together with very strong statements saying that, we will stand together and we will do whatever it takes to sort of mitigate the impact. The euro is at 1.09 now. That's a 0.5% appreciation for the euro. This is all this morning trades that are taking place. The yuan has weakened to about a 2-month low, but even for the yuan, the reference point that the PBOC sets every morning is stronger than what the markets had anticipated. So that's a little bit on the currency side. Nilkant, great to be listening into your views. So for someone sitting here in India and watching all this, very simple question. Should we feel slightly relieved because we are not as badly impacted as a lot of the Asian exporters, export-facing economies? Or is there a lot of reason to worry because of the second and third order effects? What you said, 1% being shaved off global growth itself, which eventually will come back to hit us as well.
Well, I said more than 1%. I said 1% because of investment getting delayed. That's a broad ballpark back of the envelope, Nick. And in addition to the 0.6% of volatility.
In addition, so it's 1.6%, yeah. Overall impact on the global economy, yeah.
Exactly, which is at the first shot, right? And so now we have to see second order, third order effect. So this is not going to help anyone. And I think previous speakers have also mentioned, and it's a reasonable number to work with, that we are slightly less affected directly. And remember that many of the problems that we had self-inflicted on ourselves, we are starting to solve them. Like the liquidity side, I think the RBI has been very proactive and it has shown a lot of action after stating its intent. And therefore, the liquidity premium that existed, which was very significant and which was actually slowing down the economy, is now very quickly getting whittled away. So the domestic economy actually should be on a better footing for its internal demand. So India economically, I think, will be less affected. There may even be new opportunities that come up. So if Vietnam is not in a hurry to bring down its tariffs, then there is a lot of apparel, footwear. India becomes relatively cheaper. I mean, there's a 20% gap between Vietnam and India. The tariffs on Vietnam versus tariffs on India. It's an advantage that can actually start to play out in our favor. I mean, it's very unlikely that footwear and apparel will start getting manufactured in the US because of these tariffs. So there may even be opportunities that come our way. But the channel through which I think the impact will be the worst will be the financial markets. So remember that people are just about starting to cope with the fact that this uncertainty will be there for a long time. The Fed put that the markets had become addicted to over the last 3 decades, that whenever there is a problem, the Fed can cut interest rates and the things will get sorted out. This time, it is a much, much more complex problem. And the equity risk premium, which is the inherent uncertainty, which prices in the inherent uncertainty of returns in what is actually a much riskier asset class than bonds, is something that was too low and will now start to rise. So we should get used to lower price to earnings multiples. This will get priced in over several quarters and years, but I think it would be, while we are less affected because of this, in fact, the gap, as I said, between MFN rates and what has been imposed is perhaps India is much better off. Second, we are less exposed to global trade on the good side than we have than many other countries. And thirdly, our own economic headwinds that we had created for ourselves are now starting to ease. So economically, I think we'll be fine, but I think the financial markets, the currency markets, I think are going to get badly affected.
All right. Hi, Nilkant. Good to hear your thoughts. And as you said the last time around as well, equity markets could be in a bit of a dizzy and could be in a bit of a flux, as you had mentioned last time around as well. Just want to clarify a couple of things. For the Indian GDP forecast, do you see any kind of hit? Are you factoring in anything? You've already mentioned longer term that could be throwing up an opportunity because the tariffs on India are not as much as some of our peers. So in select sectors, there could be opportunities. But in the near term, are you pulling back GDP estimates by any amount? And also, what about the RBI? You know, the Fed is unlikely now to go ahead and cut as much. At least that's the feedback we've got in the last few hours. Do you think the RBI has it in them to effect a couple of more rate cuts for the remainder of the Yes, please.
Any change that happens over a few hours can very quickly reverse over the next few hours as well. So remember that as the economy starts to slow in the US, and it is reasonable to expect that growth will slow because even though tax cuts may be introduced, there will be a lag before they start to show up, but the price shock will be immediate. So we'll see. I mean, how that plays out. In fact, it could actually happen that the US goes into a very sharp slowdown, and in which case the Fed then sees room to cut rates. So those things will change. I think that's something that we have to get used to. But when I think about the Indian economy, see the headline level, which is the easiest to do. If you exempt pharmaceuticals and some other sectors, and you focus on what is the change in duties, effective duties, and assume that in the next 6 months, by September, I think the assumption is that the bilateral trade agreement will be done, and by then India would have actually negotiated down some of these rates. The actual impact could again be only about $8-10 billion, and as of now it seems it's 15-20. But it is wrong to expect that all of that will be borne by India. I think it is reasonable to expect that, like we discussed about smartphones, that some of the a reasonable part of that cost will be borne by the US consumer, because there's no way that those kind of price cuts can be offered by Indian producers. So I don't think the direct impact is that big. I think the second order effect, because of the prolonged uncertainty, the fact that global GDP itself may be slowing, that there could be IT services.
Sorry, Nilkan, go on. Sorry, go on.
So the prolonged uncertainty, think about what happens to, say, IT services exports. So those are the kind of things that we should worry about. So versus yesterday, today, is my GDP growth forecast going to be lower? Absolutely. Will it be 1 percentage point lower? Will it be 0.5 percentage point lower? Too early to say. But I would re-emphasize that I think RBI's rate decisions are going to be far more affected by how good the monsoon is, how the hailstorms are affecting yields of wheat, how monsoon shapes up, rather than what the US Fed does. On the currency market, there may be some more volatility. I think you were asking the previous speaker about FII flows. Clearly, in this uncertainty, people will pull back from EMs, especially given that we are in the same basket as China and Vietnam and Thailand and many other countries which are very badly affected. So on the dollar flow side, I think RBI again will have to factor in the fact that they may have to intervene again to protect the rupee.
Got that. Nilkant, I had a couple of questions. One, do you have a specific view on pharma? Because pharma today, from a market point of view, is rallying. It's been exempted for now, looks like, but they've made a special, they've put pharma in along with other sectors like semiconductors, etc., where they're saying it's part of a review and sector level tariffs may still come. Or you think we should go with the fact that, well, it's not going to come? It's not happening. It's exempted. Do you have a strong view?
There is no way to have a strong view when you're not controlling the decision-making process, so you don't even know how the decisions are being taken. You only understand the broad objectives. Frankly, on pharma, this is not something which is very critical for labor and job creation. And I'm not sure if the US wants to disrupt a very large part of their healthcare system. So my understanding, my assumption would be that, and given that the manufacturing cost gap between India and the US is like 80%, so it's very unlikely that that's going to come in. It'll only increase costs, increase insurance premiums and all that. So frankly, I don't think this will get affected. This is too small for the US to bother about, and it is too critical for affecting the support base of the Republicans. So I think the risk is lower, but you're right. The reason they have given is that these are critical. There are things that we don't have, so we need to sort of keep them out for now. Whether they will pull it back when there is a negotiation happening between China and US and India and US and say that, you know what, we are now bringing this back on the table. Those are kind of things that can happen, but at this stage, I think it's reasonable to expect that they will not be.
And Nilkant, Prashant, by the way, you're asking Nilkant the hardest question, almost asking him to read Trump's mind. I don't know if his advisors or even his wife can really read what he's about to do next, right? But maybe she has an ear into these things.
I just want to ask Nilkant one thing, Nilkant, and you'll have a good sense of this, right? You said India is domestic facing, and so that's a good thing. So in that sense, lesser impacted economically because of these tariffs. Do you think the government and the RBI is already starting to do it, kind of, put all their efforts towards sort of really priming the economy in that sense to be able to withstand this global hit a little more. RBI meets on the 9th of April.
Yeah, but see, RBI has already taken a lot of action.
Correct.
Remember that they had taken out about 5 lakh crores, 5 trillion rupees of liquidity because of the dollar interventions between September and January. They have now re-injected 5.5-6 lakh crores, and
it was more from the fiscal side, Neelkant. Sorry, government side.
So government fiscal deficit. In fact, the government is already going to be less of a headwind. Remember that this whole narrative that the government was supporting the economy and is no longer because capex growth is not happening as fast is absolutely wrong. The government's fiscal deficit fell by 80 basis points of GDP in FY24. It fell by another 80 basis points in FY25, and it's basis points in FY26. So the government is less of a headwind than it was. And remember that it is because the Indian government has stuck to its consolidation path that the 10-year Indian government bond is one of the safest assets in the world right now. And you're seeing yields come down. We are seeing for the right reasons, demand-supply reasons. And therefore, I think from the government's perspective, I would expect that, slight more push on domestic demand factors. Remember that we also have the advantage of having a real estate cycle, which is coming off of a 10-year downturn. It's only been 2-3 years of an upturn. There's a lot of room for growth there. So some of those policies, I think they can be definitely supportive of domestic activity levels, even as the world goes into this reset.
So finally, Neelkant, and last question, which would be a good segue into our next discussion as well. You discussed pharma. I just want your final take on two more important sectors from an export sense. They were important for India, apparel and textiles, of course. And then there's electronics, where so much work has gone in the last couple of years. Do either of these two sectors, do you think they could potentially stand to benefit because other countries have been slapped with tariffs which are far higher than where we are as well?
Absolutely. I do think so. Given that on a relative basis, now if the formula is what it was, then perhaps it explains why India's tariffs are a bit lower. But either way, the fact that that India was losing out on apparel and footwear because we didn't have an FTA with the US and Vietnam and Bangladesh with their relationship with the EU and US were benefiting. Now that these tariff walls become less extreme for India, will become relatively will become an advantage. Similarly, on electronics, there is so much more that can happen out of India. Think about the fact that one very large smartphone company, despite being part of PLI, had actually shifted production, most of it incremental because they were losing global share, had shifted production to Vietnam, or was doing more in Vietnam than in India. Maybe now it's an opportunity for them to start doing it in India. So there are things that can happen.
But Neelkant, on electronics, I'm just going back by everything that we've heard on iPhone, right? Because Trump always takes these, poster boys of the US dream, whether it's Harley Davidson or whether it's the iPhone. And he's been saying that why can't we make these iPhones here? And we know there's a fair amount of investment that's already gone into Foxconn's factories. The Tatas are manufacturing for them. The Apple stock, by the way, was down 6% overnight on the fears that a lot of this perhaps will have to go back to the US. So are you still confident about electronics exports as a growing story?
Yeah. Remember that this is the first salvo. We don't know what the bilateral trade agreements between India and the US are going to show up. The fact that the US wants to do more semiconductors is understandable. Does the US have the manpower, which can assemble smartphones at a wage rates of 12 to 14,000 rupees a month? Is something that I think cannot be changed by tariffs. So if the concern is bilateral tariffs, I think it's the US interest. Remember that they're trying to solve for their self-interest, the end of multilateralism. They're trying to solve for generating revenue out of import tariffs. But they also realize that economically it is no longer viable for them to be assembling stuff in the US or even doing, say, camera module assembly or display module assembly. So these are things that economically are just not viable in the US. And if India does the right negotiations and can bring down the tariff rates on certain items, they will get the right rates for importing in the US, exporting to the US as well. So I don't see this as an insolvable problem, or that electronics now the story is over. I think that would be a wrong interpretation.
All right, absolutely. And Nilkant, really appreciate you joining us with that perspective. Really helpful as a frame of reference to think this through. And you may want to, if you are so inclined, can listen into the next conversation. We have the management of Arvind joining us, and we'll focus on textiles as a space, not just for the company, but for the sector. It's a sector conversation which we're going to have. So we'll take that break, and we'll have Kulin Lalbhai of Arvind join us on the other side.
Welcome back. So just a quick check on the markets again. The small flash of green that we had on the mid-cap index, that's kind of, given way. It's again a decline of about 0.8% right now. The Nifty is still nursing a cut of about 100 points. That's the situation. Let's talk about the tariff implications now on the textile and apparel sector. And to do that, we have with us Kulin Lalbhai, Vice Chairman at Arvind. Kulin, great to have you on. This just takes me back many, many years. I started my career as a reporter on textiles and apparel exports. And I remember that was the time, 2005, when the WTO quotas were going out. It was all about the India opportunity. 20 years later, Bangladesh jumped in, took away a lot of that opportunity. Vietnam jumped in, and there was always China. But is this a new reset? Is this, so to speak, a second lifeline for the Indian textile and apparel export sector? Because our tariffs are lower than a lot of these ASEAN countries. What do you make of the overnight announcements?
Yes, I think the overnight announcements, of course, they are very large ones, and we'll have to digest them in the days to come. And it'll remain to be seen, how the discussions progress, because honestly, as others have also been saying today, this seems to be an opening salvo, and there's going to be negotiations happening. But I think if one just takes a step back, I think this whole geopolitical realignment which is happening, China plus one, Vietnam and Bangladesh have been big beneficiaries of the market moving away from China. And India relatively was not getting as much of that business as we possibly could because of different tariff and market access issues. And now if you look at it a little bit more holistically, with India discussing with the UK, EU, and the US, I think if you take that as the frame of reference, then this could be a very, very exciting time. Because I think India is looking holistically at a multipolar world and how we can engage differently with the West. And if we are able to land all of these negotiations in the right place, it could definitely be a step change for the entire sector.
Hi, Kulin. Good morning. Good to see you, Ben. Kulin, just going by the stock price reactions, the street believes that it's an opportunity for you guys. You conquer that, the tariffs put on India are not as much as some of our peers. So in that sense, it could be an opportunity. Do you agree?
Yes, I think, of course, relatively to all the other competing countries, the tariffs put on India are lower. So by that logic, of course, there would be that advantage. And I think if there is a parallel conversation going on a bilateral trade agreement, I think that makes it even more exciting, because this is the chance to really see how the US-India trade can go to that $500 billion mark. And there are a lot of sectors such as textiles, footwear, toys, where as the discussions progress and a zero for zero sort of opportunity could emerge, that would make it very exciting. I think in the very short term, there is uncertainty. Of course, these discussions will be progressing with multiple countries. So we'll have to see in the weeks that follow how the discussions are progressing.
But the global retailers, they could tell people like you all that, that absorb some part of this impact. So in that sense, it could hurt profitability. What is your take on that?
Yeah, I mean, see, this is a very live discussion, so we don't know exactly where it's going to land. But all the production in the world is largely in Asia. And these industries are industries which are low-cost manufacturing. So there is a part of it which perhaps could be coming down to negotiations. But if the tariff increases are large, then of course they would also have to be borne by the US customers.
So Kulin, just exactly that. The tariff is 27%, by the way, not 26, 27. Our teams have confirmed that. Out of this 27% additional cost, rough breakup right now, how much do you think Indian companies will be able to absorb? How much will be passed on to the US consumer? Because that will also impact demand, which could be, which could be another hit.
Yes, I think it would be something which would have to be passed on to a large extent in industries like electronics and textiles. But again, I come back to the same thing that I mentioned earlier. I think this is an opening discussion. And I feel that the real opportunity that the two countries have is to get into these bilateral trade agreement discussions. And I think a lot of a large win-win opportunity can come out of this. I think another aspect that I think this announcement brings is the opportunity to speed up our discussions with the EU and the UK, because I think world over you will see new trade agreements happening with higher speed and higher efficiency as the world recalibrates to these things. But you are right about the fact that if large cost increases happen in the US in the short term, there could be some demand consequences there.
All right, Arvind, I hope you will join us again as the story progresses, as negotiations take place, and you yourself and your team get a sort of better sense since this is only, the story is only, 7-8 hours old. Thank you very much for joining us on this important day here on CNBC-TV18. Well, let's move on and get another sort of perspective. Sameer Narang is now joining us. He's head economics research group at ICICI Bank. Pranjul Bhandari is Chief India Economist at HSBC. Thanks very much, Sameer and Pranjul, for joining us on this important day. This is, of course, as we've been discussing, much harsh. What's been imposed is much harsher than what anyone thought. Let's just contextualize this for India. Sameer, if you can start first, what is your own assessment of what's the hit? It's, of course, very simplistic because there are negotiations, there will be give and take, etc. But on a static basis, what is the hit as you see it?
So, Prashant, as all of us know, we export around $85 billion worth of goods to America. Services is on top of that. And goods typically will have, lower elasticity compared to services. So you should expect on the goods front, perhaps a 10 to 15% impact directly on India's exports to the US, and that that amounts to somewhere around, given our overall exports to the US, $8.5 billion to say something like $15 billion. So the base case impact in our sense is that should be around 0.3% of GDP. But as has been pointed out earlier by some of the panelists, that India should also benefit given the fact that tariffs on India have gone up less than what they have gone up on China, on Vietnam, and some of the other countries which are doing a lot of contract manufacturing. So ideally, we should be better off.
To that point, and we just had the management of Arvind with us, but you've got to start with the basic sort of cost of production as well, right? I mean, is there a big difference in some of these areas on cost of production, say textiles, footwear, etc.? I mean, are those countries much cheaper? So even the tariffs for them are rising more. I mean, is it a big advantage? Is it an advantage? Does it open up a window, as some are saying, Samir, quickly.
It will, Prashant, because the cost of assembling these products in India will be far cheaper, because the wage component will be a very significant part in any assembly work that is being done, including services exports. So given that, if we can get our infrastructure right, and cost of shipment is, and logistics costs are in line with the Asian countries, I think it's a very big opportunity, because the 10 to 15% differential makes a lot of difference in terms of margins for the final retailers.
Pranjul, good morning. Thanks for waiting. What is your sense on some of the numbers? I'm assuming the numbers are what they are, but what's your perspective on how things will progress from here? Some have said this is an opening gambit, very maximum, highest cap, and then you kind of work back from there. Your thoughts, Pranjul?
Well, look, I must say that the situation is very fluid. If I come back to your channel in a few months, I'm sure, we'll be talking very different sectors, making very different points, because things are changing so much. But I think my thoughts from what happened last night, number one, of course, it's come as a bit of a shock, because, when I was seeing a lot of analysis around me, in a way, people were assuming a 10%, tariff addition to India, and it turned out to be more like 27%. But I think the silver lining, of course, is that, some of the other countries have got it even worse, ASEAN, China. So in a way, we're not doing that badly. So some sort of luck out there. But having said that, I think there's a lot of fluidity in a few things. Number one, in terms of which sectors are winners or losers. As in today, everybody's excited about pharma, but it's possible that something gets slapped on pharma, say, 3 to 6 months down the line. Today, we are not that excited about textiles or maybe electronics, but it's possible that, with the bilateral treaty, something sort of changes for textiles and it becomes a completely new opportunity for us. So this whole list of winners and losers are going to change dramatically. And I think that's going to bring a lot of uncertainty and volatility, into the markets. In terms of growth numbers as well, I think we need to think carefully between the direct impact on growth and the indirect impact on growth. My own sense is that, very simple back of the envelope calculation, 27% increase in tariffs across sectors, excluding pharma, can shave up about 0.5 percentage points from India's GDP growth. If you assume that some sectors are there in which the US consumers will take the hit, maybe it won't be 0.5, it will be 0.3 percentage points of growth drag in the short run. But I think this is not where the story ends. I think the second half of the story is more important. How much does global growth slow? And on the back of that, via second round effects, how much does India's growth slow? And one thing I'll be watching there a lot is FDI flows around the world, because they are a very good indicator of capex. If it slows across the board, it means that global growth, global investment is really falling. And the second round impact on India's GDP growth can actually be harsher than the first round impact. So I think these are the few things we need to think carefully about. Of course, our silver lining is that we have inflation which has fallen substantially. Our sense is that we'll have inflation below the 4% target for several months in a row, which gives a sort of long rope to the RBI to ease, something it's already done. I think we'll also see changes in its liquidity management facility. It's taken liquidity from deficit to surplus, but what we may see next is steps on how do you make this surplus a little bit more permanent in nature. So banks get the assurance and it actually adds to growth over time. So I think there's a lot of monetary policy easing that is there. The opportunity is there. And then the second big thing that India has, which a lot of other countries don't have, is services exports. It has not gotten into protectionism yet. It's rising very rapidly, at least right now. And that gives us this immense buffer, which many other economies don't have.
I think, I almost want to say to all of us, because who knows, right? I mean, services exports, God forbid if he starts looking there, then we have a real problem. So, well, fingers crossed. Hopefully, we're not going to go down that road anytime soon. But Pranjul and Samir, just a quick question to take that point forward on the RBI's response to what we're seeing. Pranjul was talking about the liquidity measures anyway that the RBI has been unleashing. Durable liquidity is what it's all about. Samir, comment on this. Do you expect any added measures over and above the prevailing domestic conditions and RBI's own liquidity mandate because of what's happening now with these tariffs? If you could quantify more liquidity steps, how many rate cuts, what are you expecting this year?
Well, the current liquidity framework, was started in 2019, operationalized in 6th of February 2020. And in that, the change from the previous framework was that the fixed repo facility, which was available to the banking system, was taken off. And it was desired that system liquidity should be in a little bit of deficit for effective monetary transmission. Since then, a lot has changed. Particularly, we have 24/7 payments. And banks have a preference to retain or hold some liquidity rather than, give it in the call money market. So in the current framework, perhaps the changes that would be required, as Pranjal was suggesting, would be operationalizing perhaps a fixed repo window in which banks have an on-tap facility which can be utilized anytime, and that will give them some comfort. It will also give a signal in terms of to the banking system for deposit costs to come down, because ultimately, unless and until deposit costs come down, for the system as a whole or for the economy as a whole, cost of borrowing on a durable basis is not likely to come down to that extent. So I think those are some of the steps on the liquidity front one should expect. We do expect RBI will continue to maintain positive, durable and surplus liquidity. And on the rate
cuts, rate cuts just very quickly.
Yeah, 25 basis points in April. Overall, I think given the impact of the current, tariff, there is a possibility that the RBI would like to also, change stance and give a signal that they would expect the liquidity surplus to continue. And this is a cycle on the liquidity and rate front, which will perhaps prolong for some more time.
Pranjal, April 9 expectations and beyond. Rate cuts?
Yes, so we think RBI can cut a lot from here on. We expect 3 more rate cuts in the year. 1 has been done, so 3 more. Overall, 100 basis points rate cutting cycle. That's 1. The second is liquidity. It's been infusing a lot of liquidity, but I think over time, steps might be taken to make them more permanent in nature, as I was saying. Third is, regulatory easing. A lot of steps have been taken. For example, bank lending to NBFCs, all of that has been eased a bit. And our sense is RBI is sort of going to be a little easier on those fronts. And fourth, something which a lot of people don't really speak about, the rupee. I think it's good to see that the rupee, is looking like a more flexible currency at this point of time. I think this has a lot of benefits. And one big benefit is that if over time supply chains get rejigged and manufacturers want to put plant in India, they want to get assurance of a flexible, market-friendly exchange rate. So I think the fact that we've moved towards that direction is also positive for us. So I think on all these 4 fronts, I must say, central banking, RBI will be the only game in town, in my view, for the next couple of months in order to lift growth. It's not going to be fiscal policy because fiscal policy is tightening, and that's probably something good. We've taken it for granted because we have it. But, the countries that don't have macro stability are paying a price for it in terms of market turmoil. Thankfully, we have fiscal, which is showing market discipline and macro stability, and monetary policy, which is supporting growth and is easing. So we have this very nice combination of growth and macro stability, which is to our favor, in this whole world of global storm.
All right, storm it is, and no one wants to touch that. The fiscal stability and, of course, lower bond yields, etc., all a consequence of that. But RBI, 9th of April, of course, rate cuts expected, perhaps assurance that liquidity will remain ample. Thank you very much, Pranjal, for joining us. Samir, good to see you back on the show. And we will chat again. As Pranjal, you said, next time we speak, I think things will be, different, and how different we'll have to see. But thanks once again, both of you. We'll take a quick commercial break here. Markets are not doing bad at all. We're down just 70 points. And by the way, briefly, the Nifty Bank had come into the green. It is in the green as we speak. It's up 30 points, but it is in the green. And I think we should just look at the small and the mid-cap indices. Small cap index is down 0.2%. And I think the mid-cap index is also down a little bit more, 0.6% or so on the mid-cap index. Take that break. Nilesh Shah of Kotak Mahindra Asset Management Company with his views, his perspective on the other side.
Welcome back. Well, the market's not doing too badly. The Nifty is down only around 60 points. And the point we made earlier this morning was if the Nifty needs to fight back, it has to be on the banking names. And that's precisely what's happened. The Nifty Bank is now up close to around 100 points. Remember, the pharma index is outperforming, but there's only so much the pharma index can do. You have the big names, the banking names that have moved up, and that explains the recovery. Nilesh Shah, Managing Director at Kotak Mahindra AMC, joins us on the show. Hi Nilesh, good morning. Good to see you win. Well, Trump's tariffs have been announced, at least for now. And it appears, though India is going to be levied that 26-27% or thereabouts, is at least relatively lower in comparison to our peers. How do you approach the Indian markets from here on?
So one, Nigel, President Trump has proven Sant Tulsidas correct. Sant Tulsidas wrote centuries ago, Samrat ko nahi dos kosai. And President Trump is proving that for weaker nations, WTO is there. For stronger nations, WTO doesn't matter. In fact, he has historically coined new definition of import duty, which is your trade surplus with US divided by your exports to US. That is called import duty. I'm sure we are going to see one Ivy League case study on this new definition. There's one interesting WhatsApp forward which I have received. I haven't checked the authenticity, but it has come from a reasonable source. The US has imposed mass tariffs twice in its history. One was in 1828 and second one was in 1930, roughly about 100 years apart. And both of that resulted into recession or Great Depression. Coincidentally, third tariff mass hike is also coming after 100 years. And as that WhatsApp forward suggested, you need all the people to be dead who remembered the impact of tariff on the economy before you can play that game again. Clearly, this is one game which is lose-lose for not only US, but also for other countries. There will be higher inflation in US if tariffs come into play. There could be impact on growth as supply chain gets disrupted. And this could result into US stock market correcting as the Dow futures and Nasdaq futures are indicating post-announcement of tariff. Half of American household wealth is in US equity, and 2/3 of American economy is driven by consumption. Higher inflation, lower growth, wealth effect evaporating. Could this result into stagflation in US? Well, it won't be called stagflation. It will be called hard landing because US is a developed nation. Effectively, it's a lose-lose situation for the world as the theory of comparative advantages gives way for Make America Great Again. As India... Yeah, go ahead.
No, Nilesh, I was just saying that we were so glad you were joining us because you have a knack for putting things most beautifully in the best philosophical manner. And I think on mornings like these, philosophy ultimately comes to help as well. Because, you know, first it was the financial crisis, COVID, and now this all man-made. On November 5, markets were ripping higher. That Trump is great for financial markets. And now where are we? So what would your advice be to investors?
It all depends upon how situation evolves. I will still say picture abhi baki hai. President Trump has not finished. He will continue to make announcements. And it is up to India as to how we leverage this. We have been imposed tariff duty, but it is much lower than most of our peers. In sectors like pharma, there is no tariff impact. In sectors like garment and footwear, soft toys, we could probably get business from our Asian peers. IT sector will get impacted as technology spending slow down if American growth slows down. And we'll have to be also careful about how China, with its massive manufacturing capacity, dumps goods all over the world, including India. I think there is always silver lining in the dark cloud. And if India can go and negotiate with US, especially, by leveraging oil import or defense import and reducing that trade deficit, and also showcasing that, look, in China, where you run more than $500-600 billion deficit, you are not actually able to operate in China as freely. Your Facebook, your Twitter, they are not operating in China, but they all have free runway in India. So if we can negotiate under clause 4 of the exempt of the order and probably reduce the impact of tariff on us compared to our peers, it's a great opportunity. Markets will carefully watch how government and the entrepreneurs of India capture the opportunity and then take a call. At least as of today, market is not reacting in panic, which is positive.
Okay, so Nilesh, we hope that stability prevails. One quick last question. Remind us of the firepower calculation. In all the last 5-6 months of turbulence, it is domestic money that has helped us. Now, if these foreigners keep selling because of this global chaos, then to what extent can you keep buying? What is the average cash level? I remember you saying it was, I think, if I remember, over 2 lakh crores of firepower. But please do share the latest numbers with us.
So, Surabhi, roughly the cash balance has remained around that level. Whatever flows we are getting, it's getting invested in the large cap space mostly, and couple of small and mid cap space where valuations have corrected meaningfully. Within FPI also, we have seen passive turning buyers in the month of March, passive ETFs. I hope it is harbinger of the buying by FPIs on the active side, and if not buying, at least reduction in intensity. Now, please remember that we have firepower, but we are not here to give easy exit to FPIs. If I know their trade side, if I know they are on the selling side, we are going to buy at a lower price, not at a higher price. So money is irrelevant. Once you show the card, the game will be played based on the cards you have on table.
That's an interesting point. And while it could be slightly chaotic in the near term, as an investor in mutual funds, I'm very happy to hear that mutual funds are not here to give easy exits to FPIs, which could be on the run. Who knows how this plays out? But thank you very much for joining in, Nilesh. Always value your perspective. Well, with that, I guess move to commodities now. We have Manisha joining in. Manisha, what a morning. Good morning to you.
Well, yes, it started really early for all of us, didn't it? And yes, we have seen a very strong knee-jerk reaction come in for many of these commodities as well. Just to remind you, well, of course, there is a risk-averse scenario that we are looking at in the international markets, but all of these commodities are global in nature. So country-specific tariffs does disrupt a lot of global trade there. So markets are looking at higher than expected US tariffs. The best-case scenario that the street was anticipating was 5 to 10% and worse between 15 to 30%. And we seem to be looking on the higher side here. 10% of baseline tariff is what we've seen all countries, and then the major producer and consumer of commodities have had it on the higher side. When you look at the China markets, well, we're looking at around a higher number of 34% there. China already is dealing with 20% of tariffs, and that makes it 54% of tariffs. And remember, China is the major consumer and producer of many of those industrial commodities. So we are looking at reaction coming in for many of those. For India, we're looking at 27% at this point in time. And that reaction clearly has come in for the gold prices, which has now made 22 days of all-time highs in 2025. And we've seen 3165 break on the higher side, 3200 in the front month futures as well. So very strong gains continuing in the safe haven buying in sense of gold there. Crude oil prices, well, 80% of countries in the global markets import crude and 20% of them produce that. So we are looking at crude prices also taking an impact from this. 3% of a decline is what we are dealing with right now. There are concerns of weak energy consumption going forward in the new fiscal, and that's what's bothering the crude prices. The metals also have had a similar scenario come in. Natural gas prices fell 4%. You have COMEX copper, which hit an all-time highs in the month of March, also has declined quite sharply, 4%. There are reports from UBS and Goldman Sachs saying that if these tariffs continue, then we are looking at a collapse in sense of copper markets going forward there. Well, zinc, aluminum prices have seen a 5.5% of a decline on the weekly basis as well. But this is overnight markets, and the iron ore prices in China fell by 6%. It has been a 3% of a decline coming in for for other industrial commodities like rubber and cotton as well. And that shows you on how we've seen prices go on on weekly sense as well. We have seen some exemptions coming in like steel and aluminum articles, but remember, there already is a 25% tariff that we have seen on these metals. Auto parts is what has been exempted as well. And more importantly, while US has imposed 25% tariffs on all imports when it comes to steel and aluminum, so that is the reason they have been exempted at this point in time. The other commodities that you see exempted at this point in time is copper, semiconductors and lumber articles as well. And then it has been about bullion. By definition, bullion means gold and silver both. So as of now, there is an exemption for both of these. All exempt articles also may subject to future 232 event as well is what. So as Nilesh was telling us that this is it is not finished yet, and we could be looking at more negotiations and retaliatory tariffs, and some of these numbers perhaps pulled back as well. I also want to show you on what we've done in sense of commodities on a week-on-week basis until now, and everything has seen a decline. Barring gold, well, that's the only one that's trading on a firmer note at around 3% on the higher side. Silver is down by 3%, and that's exactly what the case has been for many of those metal prices also. So whether it's copper, aluminum and zinc, we're down 4 to 5.5% on the weaker side. So, well, yes, apart from safe haven buying in gold, everything else in the negative.
All right, Manisha, it's a very comprehensive look at what's happening across commodities right now. Time for a quick commercial break here. On the other side, our special segment, it's the economy. It's very much about the economy. Latha is going to be speaking with agri-economist Ashok Gulati and trade expert Ajay Srivastava as to which Indian sectors will be impacted most by tariffs.